We'll come to page 100, please. I told you, because in futures, we only take a position and we do not get delivery of the shares. So you have to only pay initial margin. This initial margin can be 20, 25, 30% of the overall exposure. What is exposure? Exposure is the price of the share into lot size. That is the total exposure. Which means when you take a future trade, and if I ask you technically how much is the money needed for that trade, generally what we do is we see that, let's say a future is, the contract of future is worth 6 lakh and we are required to pay 20% of that, which is 1,20,000. That is only the margin money which you are paying. But what is the amount on which you have taken a position? The total amount. Total amount is this, which is the price into lot size. Correct, no? So if a share is falling by 5%, then you should be mentally prepared that your fall will happen on 6 lakhs, not on 1,20,000. A very basic maths, but when you do the actual FNO trading, then high chances that you ignore this fact. And mostly we realize this only when we are standing in deep losses. So some people can casually have a capital of 10 lakhs and they are very aram se doing 5 trades at a time. They are doing 5 trades at a time. Now what exchange has done is, on an average, every trade should have an exposure of 5 to 6 lakhs. That is how lot sizes are decided. You can ask me, no sir, why for something it's only 15 shares, for something it's 250, for something it's 550. Why is the lot sizes varying? Because exchange has something in mind that in a particular trade, overall exposure should be in one lot, overall exposure should be close to 5 to 6 lakhs. If it goes above that, then they will reduce the lot size. Every 2 to 3 months, they will do adjustments. Then you will be notified that from next month onwards, the lot size is changing. Then they will change the lot size. If there is a significant jump in the price of a share, lot sizes will come down. If there is a significant fall in the price of the share, then lot size will go up. Understood? So basically, when you have a capital of 10 lakhs, and if let's say you are doing 5 trades, okay, then what do you think is that, okay, 5 trades on an average 1,20,000 I have to pay, which means your money getting blocked is 6 lakh. 6 lakh will immediately get blocked because initial margin will get blocked. So you still feel good that I am having 5 trades with me and I still have a buffer amount of 4 lakhs. I'm telling you practical things, what I have seen has happened with a lot of my clients. Because see, when we are doing the services, when I'm doing only the advisory services, when I'm doing the management services, then the risk management is my responsibility. But when I'm doing the advisory services, it is your responsibility to know what you, because I don't have access to your demat account. Management services is where I take the ownership of your account. Advisory services is where you have your demat, you do everything. You just ask me for a trade. My job is to give you a trade. You understood what I'm saying? So basically a person comes to me, asks me for a trade. Every morning he will say, capital is available, give me a trade. Then I am obligated to give a trade. You understood what I'm saying? So that time even I understood that, okay, I draw a line, advisory services, we don't have to tell them what they should do. Maybe they have capital, that's why they are asking for a trade. It only took me many years to understand that clients are very, very novice, amateur, that they don't even realize this. So what happens is, you are saying I have 5 lots, but I'm still sitting on 4 lakhs of money. What you're not understanding is, even if I assume that you have 6 lakhs rupees worth of exposure in one trade, which means you are taking a total exposure of 30 lakhs. which means if the stocks fall on an average by around 10 to 12%, then this surplus money is gone. And now you are sitting in deep losses. Now you come to me and say that I have got 5 lots open. Each lot is having around 10% fall in it. And now I don't have money. You suggest what to do. So at the end of the day, loss is for client. But for me, the bigger loss is that I'm losing my client. Whose mistake it is, forget about it. Then I always love taking ownership. If it's a mistake, no, it's okay, I take the ownership. Then I understood that even if we are doing advisory services, we should become more responsible and we should become strict also. That we will not give trade. You understood what I'm trying to say? Because they probably do not have the imagination power. That what bad can happen. Because your maths always go in one direction. 5 lots I have taken, 15,000 karke I will book profit. 1 go I will book 75,000 profit. Because you only like to think in the positive direction. These are practical things, guys, I am sharing with you. So when you are taking so how I used to tell them, beach mein I will make audio recording, send it to them. But they are not willing to understand that. So what happens is, whenever you are doing futures, you should always see what exposure am I taking over there, not here. This is only the margin money to initiate a trade. When fall will happen, then the broker will stop. See, broker has a very simple rule. Broker will ask you to deposit the difference on a daily basis, M to M. Mark to market. Mark to market. Today closing, sir, give so much money. If it comes down. If it goes up, then money will be showing a surplus in your account. As simple as that. Got my point? So now what I try to do is I try to tell them that you should look at that figure. If you for 10 lakhs capital, you think you can take 5 trades just because you have to pay 6 lakhs as margin money. What you're not understanding is with total of 10 lakhs capital, you are taking exposure of 30 lakhs. That is some real guts. Some real guts is needed for doing that. Because all your profits and losses are calculated on 30 lakhs. So in a bull run, you make money. But when the bad time comes, it wipes out your money like anything. Okay, so now there are 3 types of margin. Theoretically, this is what we study. Practically, now they are becoming more and more vigilant and more strict. They have exposure margin, this margin, that margin. We don't have to go into all that. Honestly speaking, even I don't know some of them, because at the end of the day, it is all system oriented. They do it. But practically, if we have to break it down, then there are 3 stages of it. One is the initial margin, which is a margin to be deposited as soon as we enter into a future contract. It generally ranges from 20 to 40%. Generally. Can it be more than this? Yes, it can be more than this. If it is a volatile counter, it can be more. If you plan to buy a future of Adani Enterprise, you may end up paying 60-70%. May. Because volatility is humongous over there. So exchange will keep the margin requirements very high over there. Because over there 4-5% fall, 6% fall in a day is normal. So they will keep the margins very high. What is maintenance margin? Maintenance margin is the trigger point. And if the margin goes below the same, then there is a margin call on the client. Okay. And then what you deposit is the variation margin. If margin balance goes below the maintenance margin limit, a variation call is made and trader has to furnish margin to bring the margin balance back to the initial margin levels. Whatever is the minimum margin required, that much balance you have to again bring into the demat account. Okay. Now, how this margin is determined, guys, I have given a detailed analysis, just giving you a small understanding. So there is something called as clearing house. Okay. The clearing house is basically responsible to make sure that nobody can default. So between a long and a short, there is a clearing house. You understand one thing, right? When a trade is done between A and B, one person will always be happy and the other person will always be sad, because one has taken a long position, the other has taken a short position. Okay. Now, what clearinghouse will do is, let's say it will take the data of last 365 days to understand what kind of movement has happened in a stock. So they take the closing price. We are always interested in the closing prices because your mark to market is done based on closing prices. So they take the closing price, they take the value of a future contract, because I told you for every contract the exposure is closing price into lot size. So they multiply that with lot size. Then they try to calculate something called as daily absolute change. That daily absolute change is denoted as X. Every day, how much average change happens in a one lot. Okay. So they take the average of that for 365 days. This they take it for 365 days. Okay. And then they find out the average of this X value, which we refer as mu. Okay. We refer it as mu. So mu, let's say, comes to 15,000. That is the average of daily absolute change. That is mu. Then what we do, we take this mu and we take the standard deviation of X. What is standard deviation? Standard deviation is how much it can deviate from the average. So we have, I don't know if you remember this, but in statistics, we studied something like this. One standard deviation gives you how much confidence interval, 66% something. 2 times the standard deviation gives you 93% or something. 3 times gives you the 99% something. So what is the maximum deviation which can happen? So 15,000 if the value is, and you say standard deviation is 8,000, which means on the upside it can still deviate by another 8,000, and on the downside also it can deviate by 8,000. So upside it can go up to 23, downside it can come up to 7,000. But we don't go for 1 time the standard deviation, we go for 3 times standard deviation to capture the maximum potential risk, because end of the day clearinghouse will not allow any party to default. Because see, if long is standing on plus 5 lakh on a trade, plus 5 lakh, his is a profit of 5 lakhs, then short has a minus 5 lakh. Under any circumstances, they cannot afford this, that minus 5 lakhs is not paying the money, because then you don't know B. When you take a long position, you only know one thing: I have taken a long position on the exchange. Exchange trading, you don't get to see the other side of the party. So who are you going to challenge? You are only going to challenge the exchange. First you will challenge your broker. So broker responsibility. If broker says no, money has not come from that side, then exchange will be responsible. So they're very strict about it. So what we do, standard deviation is a popular measure used for capturing the risk. Risk is the deviation. Okay, risk is the deviation from the average value. It explains how much the actual value can deviate from the average expected value. Okay, according to the concept of normal distribution, a variable can deviate from its mean maximum to the extent of 3 times the standard deviation. So what we do, the initial margin is calculated as mu. Mu is what? Average of daily absolute change plus 3 times the standard deviation. We take the maximum standard deviation possible. Maximum standard deviation possible statistically is 3 times the standard deviation. So 15,000 plus 3 into 8,000. So total 39,000 margin will be required for this particular trade. Who has to give this? Both A and B has to deposit. Both A and B with the clearinghouse. Understood? The amount needs to be deposited by both A and B in their respective margin accounts. I have written this also practically as a market participant. We are not interested in the above computation, as the broker will straight away let us know the margin to be paid. All this is now becoming system oriented. You open your demat account, you try to put a trade over there, it will start reflecting this margin is required. If you have sufficient margin, they will allow you to execute the trade. If margin is not there, they will cancel your contract. Understood? They will deny the contract. In exams too, most of the times margin balances are given. However, if in case it's not provided, then we use the equation mu plus 3 times standard deviation. Yesterday discussion that we did was on stock and index futures. If you remember, I told you stock futures, you thought I will go for buying Page Industry future. That is, you have taken a long position. You can also take a short position. We also discussed that you can also take a long or short position on Nifty futures. If you're bullish on the overall market, you don't have stock specific knowledge, but you have the bullishness on the overall market, then you buy Nifty future. Why do people buy Nifty future? Because they, let's say I ask you, how do you think about Indian economy? Very bullish. Why? Modi government will win the elections. Which sector do you think will do good? That I don't know. That Mr. Modi will think. So what do you think? I think overall markets will go up. So what do? You don't have stock specific knowledge, but you have a market knowledge. So you go long on Nifty. You understood what I'm saying? Day before yesterday, markets closed on a very negative sentiment. Very negative. Day before yesterday, evening time, when I called off the class, you came to me. You said, sir, I think tomorrow also markets will continue with the downside trend. But I think OFSS is going to come up with very good numbers, which means you're negative on market, but you're bullish on a stock. So sir, I am thinking tomorrow as soon as market opens, I'll buy OFSS future. Stock specific betting. You understood? So first you have to decide what you want to do. All the time there are both opportunities available in the market. You want to do stock specific because you think a company will post good numbers, or you want to bet on the overall market. Okay? You can do a mix of both also. So index futures, stock future. Now we are talking about currency futures because you have studied Forex, so we can look into it. Currency futures. Again, currency futures, what I told you, if you are bullish on dollar against rupee, you cannot simply go to a currency exchanger and tell him, hey, give me $10,000. Okay, why you need it? I think in 1 month it will go up. So I want 10,000. You can't do that. So what you have to do is, you have to go to the futures market and you can go long on dollar. You can go long on dollar. You understood? But sir, I am bullish on rupee. You can't buy rupee futures in India. You understand? The maths does not work, right? How do you buy a rupee futures in India? It doesn't work. In India, you will have all other foreign currency futures. All other foreign currency futures. So if you are bullish on rupee, then you go short on dollars. You understood what I'm saying? Okay. So similarly, if you want to do rupee futures, maybe you can try the US market. In US market, dollar futures will not be there, but rupee futures will be there. Okay. On 15th July, pound futures for maturity August end are traded on the international monetary market at $1.2450. Lot size is given as pound 62,500. A trader bullish on dollar against pound takes a position in 14 future contracts. So trader is bullish on dollar and he takes a position. They have not told you long or short position. What position will you take? Long. Acha. I told you, if I ask a question, if you have an answer in less than 2 seconds, better give the other side. But he already said long. And it is wrong. You are bullish on dollar. But what futures are available? Pound. Some is very clear about it. You are bullish on dollar, but pound futures are given, so you have to go short. Why don't you read in everything? Why don't you read it? Why is it that from bullish you simply jump to long? Something is in between. No. What is given, that you have to see. Trader is bullish on dollar against pound, which means if he is bullish on dollar, it means he is bearish on pound, so he will go short. Okay. Another thing, guys, very, very important is that if they did not say these are pound futures, then also we know this is pound future because the currency in which lot size is given. Lot size explains what currency future is available. If it is a pound future, then lot size will be given in pound. So in this case, anyways, they have been very clear with their language that pound futures are available. But if they do not specify also, I can look at the lot size and decide what futures are available. Initial margin is $1,000 per lot and maintenance margin is $750 per lot. Future price for subsequent days happens to be, you have taken a short position at 1.2450. Now the price next day comes to 1.2420, which will be good for us. Then it goes to 1.2490, which is bad for us. Then it goes to 1.2520, which is again bad for us because it is going up when I'm betting down. And finally it goes to 1.2430, which will make you happy. He squares off his position on 19th. So if you compare only the first day and the last day, you entered at 1.2450 in a short position. It comes down to 1.2430. So there is a profit for you. How much is your profit? 1.2450 minus 1.2430 into number of lots, 14 into lot size 62,500. Your profit will be in dollars because I told you, you remember, I told you your profits are always in price currency. Your profits are expressed always in price currency. Another danger zone where students have a tendency to write wrong currency. Always remember, your profit or losses are calculated in price currency. Okay. So let's see the solution. The trader is bullish on dollar against pound, that is bearish on pound against dollar. So he goes short, that is F minus on 14 pound future contracts for maturity August end at a price of $1.2450 per pound. Initial margin 1000 into 14, 14,000. Maintenance margin is 750 into 14, 10,500. Which means if your balance goes below the maintenance margin of 10,500, then margin will be required to be paid. So first date, future price, action taken, margin balance. On first day, you have deposited the initial margin of $14,000. Next day it becomes 1.2420. You calculate a profit which is 1.2450 minus 1.2420 into 14 into 60 to 500. So your margin goes up by 2625. That is the profit you have. Next day 1.2490. There is a loss. You always compare with the previous closing, guys. The previous closing was how much? 1.2420. Okay, so 1.2490 minus 1.2420 we have done into 14 into 60 to 500. So your balance comes to 10,500. They will still not call for margin, because if it goes below that, then they call for margin. Next day it becomes 1.2520. There is a loss. Okay, and because your balance now has gone to 7875, so you will have to deposit the variation margin. How much variation margin is to be paid to bring the balance back to the levels of initial margin? Okay, and finally he squares off his position, so he will get 21,875. What is the profit? On the next page I have shown there are two methods. Either you simply do cash inflow minus outflow. I personally don't prefer that method. That is a little kiddish. You go with the second method. What is the rate at which I initiated a short position? What is the rate at which I squared off my position into number of lots into lot size? Just go through it. Whenever your balance goes below, you can't bring it up to 10,500. That is stupidity, no? Again, next day if it goes down by 100, again you will bring 100. So that is for the sake of convenience. They tell you to bring it back to the levels of initial margin, because that is the total drop which has happened. From where did you start falling? From 14,000. So they will ask you to deposit equal amount. I am telling you again, this is the theoretical stuff that you're studying. In derivatives, unfortunately, there is a lot of stuff which I have to teach you theoretically. As a person who practices in equity market, it is my duty to tell you what exactly happens in real markets. That is your edge over other students. And that is why I'm telling you, in real life, there is no such thing called initial margin, maintenance margin. Initial margin is there with which you can initiate a contract. After that, we follow M to M. That is every day. If you are going, they will not tolerate it even for a single day. If you go negative, they will send you a message that your margin balances are showing debit balance. If you don't add up the money, we will square off a position. One warning, two warning, third time square off. Over. Only if it goes below maintenance, we will ask you to pay. All these things don't work in real life. And without giving you warnings when they square off, when the total money available is like the total capital that you have available with multiple trades, if your 95% margin is getting exposure and markets are falling drastically in long positions, then they will square off without even telling anything. They will just send you one message, because your limits are crossing, we have to square off. Some DMATs are so bad, so bad. So I tell a strict no to my clients like ICICI Securities. What they do is they do not follow anything. They have a simple principle. If you have a long position in ICICI Securities and uh, there is nothing like how much money is there in your bank account and all, on that particular position, if there is a fall greater than 2 or 3%, some risk assessment they do and they define it, immediately they will square off your position. Immediately. I have funds in my account, does not matter. So what do you need to do in that case? Then once I had a major fight with them, because what happened, we had a future of Bharti Airtel, and Bharti Airtel suddenly dropped by 100 odd rupees. This is long back when it was trading around 300, 350 rupees, 400 rupees. It suddenly dropped down badly. At rock bottom, they squared off the position. No notification, nothing. From there, it recovered 60%. At 60%, when we open the account and we see the future is not available. Now, what do you do in such a circumstance? Because even if you now again initiate a buy, you already lost that 60% recovery. So we called them up and they have some top-notch idiots, like they interviewed idiots. Oh, I'm speaking to this guy. He's like, sir, I can't help you on this. This is risk assessment procedure. But I had a lot of margin in my account. No, sir, what you need to do is manually go to that future, add margin, bring money from your funds to that margin account. Only then we assume that margin is dedicatedly available for that particular trade. You got my point, what I'm saying? Money is there. In your DMAT, money is there. You click on that position. Only for that position you keep money by adding margin. Then we will not square off. We sent mails, we did everything. It was a client portfolio. So I told my client I won't be able to continue. So now we are very strict. If you want me to manage, then you have to give me Zerodha or angel broking. These are the two top-notch. If you are very serious about your trading, then angel broking is the best. And it reflects also, yeah, 350 share has become 3,500. They're getting business like anything now. Because for serious people who are doing 10, 15 trades a day, so many options open, they don't trouble you unnecessarily. So it is unique to everybody. But in class, we study this thumb rule. Initial margin de do, goes below maintenance, variation call will come, deposit to bring it to the levels of initial. Practically, guys, I'm sorry, this does not happen in real life. You can't write in exams, so practically this does not happen, so I protest, I won't write the answer. You can't do all that. Okay, so my duty is to teach you what you have to do and tell you what happens in real life. Okay, just go through it fast. Who has to? You have to be very careful here. Switch off my system. See, you don't do it. How, sir? You don't do it, sir. It's okay. You just move the regulator, boss.
How is that possible, sir?
That is electrician. He wanted to surprise you. You think you know everything as a chartered accountant. You do it. Are you are feeling cold? Huh? No, not. Now we have gotten used to this, right? He assumed this. The switch next to the regulator has to be fan. Guys, can we proceed? Okay, listen. Next question number 2. Sensex futures are traded at a multiple of 50. Consider the following quotations of Sensex futures in the 10 trading days during February 2009. So for next 10 days, the data of Sensex is given to you. From 4th onwards till 18th, they have given you the futures data. I mean the prices of Sensex futures, high and low values. High and low values are given, guys, but we know that M2M does not work on high and low. It works on closing basis, right? So every day's closing only I have to see. Now what they're saying is Abhishek bought one Sensex future contract. Bought means he's bullish on the overall market and he has taken a long position. Now the average daily absolute change in the value of the contract is given as 10,000. That is the mu value given 10,000, and the standard deviation is 2,000. So we take 3 times the standard deviation, which is 3 into 2,000, which is 6,000. So you understand that the margin needed initially would be 16,000, right? Mu plus 3 times of standard deviation. The maintenance margin is 75% of the initial margin, which is 12,000 rupees. You are required to determine the daily balances in the margin account and payment of margin calls, if any. Okay. Now see, this question was framed at a time when generally Sensex futures were not available. Okay, so that is why I have written a note below that there is no such thing as Sensex futures. But now of lately what has happened is some brokers are making you trade in Sensex futures. Like I think even on Zerodha platform it is available. But we tell people strictly not to do Sensex futures. I mean Sensex related options and all, because liquidity is completely dried out there. So what people generally do is they either play Nifty or they play Bank Nifty. Understood what I'm saying? So Sensex you can do it, but sometimes what happens is you get struck in a trade and you only find that there are no, when you want to sell something, no, you find there are no buyers. And the buyer is sitting at a very, very low price. He wants to buy at a very low price. But because you are under pressure that you have to square off your position, so you are bound to sell at whatever price is available. Understood? So sometimes what happens is when there is a very low liquidity, something very scary happens in the market. We refer to it as freak trade. Now what happens is when you put orders, there are 2 types of orders which you can put. One is called as limit order. One is called as market order. So I keep requesting my clients all the time to put limit orders, but some of them will do what they want to do and they will put market orders. Market orders are those orders where you just say whatever price in the market buyer is sitting, I'll sell. Whatever price in the market seller is sitting, I will buy. Just 2 days back, it happened with one of my clients. He messaged me that, sir, on Metropolis, I'm getting a profit of 16,000. I said, you book it. So basically how we do it is, right now maybe you won't understand, but we do it like this: F plus futures buy and put also buy. Okay, so he sees his profit on future, but he did not notice the situation with put. Now Metropolis is little less liquid stock. So what it's told me, that's a 16,000 I'm getting. So he put a market order. For future it executed, but for put he's selling and the price was, let's say, 20 odd rupees. There are no buyers. One person is sitting at rupees 4 to buy. In between there are no buyers. But the last traded price was 20 when 2 sensible people did a trade by putting limit order. Limit order means I'll say I want to sell at 21. Buyer is saying I want to buy at 19. Both are limit orders. Now they come close. Somebody has to negotiate. Somebody will have a better bargaining power. So 20 pe last trade happened. What your demat does is 20, based on 20, they show you your profit or loss. Whatever is the last traded price, please listen very carefully, guys. So 20 was the last price at which the trade happened. Your demat automatically considers that price itself as the latest price. Based on that, your profit loss is calculated. Based on 20, his profit is showing as 16,000. If he would have put a limit order at 20, it may not have executed. If he put a limit order at 20, because buyer was not there in between, where was buyer sitting? 4. Buyer is very smart. He knows somebody will come. Somebody foolish will come with a market order. Are you people understanding what I'm saying? So what this guy did, he couldn't, he was new to this, so he couldn't resist that, oh, 16,000 in a day I'm getting. So what he did, he put some market order. Futures to trading was happening. So there was 1-2 rupees difference. Put option, sold at 4. So I'm telling you a net what happened. The 16,000 dropped down to 7,000. So after doing it, he's saying, oh, sir, I think something happened. At 16,000, I was thinking, when the position closes, no, they will freeze the statement. I mean, the trade. And they will show what you realized actually. Then he tells me, actually, I did a market order and the buyer was only sitting at 4. So suddenly 20 rupees thing becomes 4. Similar thing happens with options. Sometimes you buy very much out of the money options. Right now, you don't know options, but because I use the term freak trade, so I'm explaining you. Right now, like market is right now at 22,000. Let's say you do a trade of 23,000, which is very much out of the money, not something not in the frame. So at 23,000, there are some people very clever. They put some random price. So for something worth 200, they will put a price of 1,200. This is intentional. Intentionally, they do that. And there is no trading happening in 2300. I mean 23,000. So you come as a very, very over optimistic buyer in the market and you put a market order that buy from whoever wants to sell. Now seller is sitting at 1200. Then these people on Z Business or CNBC will notify what suddenly happened. There is you know how the graph will look. Graph will look like this. Graph looks like this. And then they will display that graph and say, what happened? One trade happened at 1200 rupees for a 23,000 Nifty. That was a freak trade. One person freaked out. He did a trade. And then markets are normal because all others are sitting with limit orders. 200, 190, this kind of orders. But one person, so the person who sold, he became lucky. Yeah, come on guys, today we'll have party. Because he made a lot of money on that particular day. So you have to be very careful. You always put limit orders, not market orders. Okay, so with Sensex, these freak trades frequency is very high because very few people trade in that. Okay, so this is now I have written there is no such thing as Sensex futures. So few brokers now allow. You can just write it over there. नहीं तो बाद में you will say KP sir does not know everything. Okay, few brokers now allow trading in Sensex. Few brokers now allow trading in Sensex. Okay, next thing guys, why would anyone deal in index futures? This I already answered you. Reason being, sometimes you are bullish on the overall market, but are not having stock specific views. For instance, you feel GST will be positive for the economy, but which particular sector will benefit, you are not very sure. In such cases, you prefer to use index futures. Modi government will win elections. Who will benefit? I mean, you can say who will benefit, but you generally want to bet on Nifty as an index. You understood? RBI monetary policy will be a very good one. Interest rates will be cut down. Banking sector will flourish. Go for Bank Nifty. If interest rates will cut down, if interest rates will come down, there will be more liquidity available in the market. Banks will be able to create more credit. So Bank Nifty will go up. So you are specific to that particular sector. Okay. Let's write the solution. Please write Abhishek bought Sensex future. Abhishek bought Sensex future which implies he is bullish which implies he is bullish on overall market. Which implies he is bullish on overall market. We assume a long position is taken on 4th February at closing price of 3296.50. And we will make profit, if index goes above 3296.5. We will make profit if index goes above 3296.5. Next line, initial margin is equal to mu plus 3 times of standard deviation which is 10,000 plus 3 into 2,000, which is rupees 16,000. And maintenance margin is 16,000 into 0.75, which is rupees 12,000. Next line, give heading computation of margin balance and margin calls. Computation of margin balance and margin call. So we take date, we take closing price, remarks or action taken, and your margin balance. So we start on February 4. 3296.50 was the closing on that day. What action we have to take? We have to deposit initial margin to initiate this contract, and your balance will show as 16,000. Next day, the price becomes 3294.40. What happens? There is a loss. 3296.50 minus 3294.40 into 1 into 50. Number of lots is 1, lot size is 50. One zero five. So your revised balance is 15,895. Next, February 6, 3230.40. Again, a loss. From your previous day, you will check 3294.40 minus 3230.40. 3,200 is your loss. Your balance is 12,695. Next is February 7, 3212.30. Three two three 0.40 minus 3212.30 into 50. 905. 11,790. On same day, there will be deposit of variation margin, right? And we understood that variation margin should bring back the balance to initial, which is 16,000 in this case. 42. Next, February 10, it has gone up 3267.50. There is a profit. Do it for rest of the days. So you got it correct or not, you can just see what I've written. If you got that figure, it means you have done it correctly. What do you mean to say? I only know how to teach 4x. Now you have to say you have no other choice. It's okay, don't speak much. They will think I paid you for saying all this. No, no, he's still there. We all pray to God that he's still there. He's there, right? That's what we were just discussing about FR classes and all. No, no, I just asked him casually that where are you people generally taking FR classes now? Normally I asked because I have come to Bangalore after a long time. That time, see, basically what happens is I've never met Niket sir. But my students, they used to come and talk to me every day after class. When I was having classes in my own institute, every day we will spend at least an hour after my class because there we used to take 3 hours morning class. I'll stay back. A lot of them will stay back with me. We'll talk classes, approach to studies. My routines which I give students, how to prepare, what strategies to use, it is also very popular among students. It means there are a lot of people who come to me only for getting the routine done, how I should approach my studies, and I'll give them some specific targets they will do. We'll spend a lot of time like that. So these people only will come and tell me this teacher is good. They will give, and they're very free with me. If they don't like something, they'll say, no, he does not know how to teach. So I probably would have recommended Niket sir to 500 odd people just because of I never saw him, I never met him, but because my students are satisfied, so I used to refer. Because at the end of the day, you should benefit. That is the whole idea. So I was asking, where did you people take classes and all? So from Niket sir, we went to other faculties, which name I don't want to specify. Like I was told this, I don't even know the name, but I was told that costing classes are good in the other institute, JK classes. I was told like this, 4 years back, I'm telling you stories. So if somebody comes and tells me that okay, you can see this faculty. Or there's another faculty for which I had a good feedback. I think Sampath sir is always good. No, Rakesh Agarwal costing classes was there earlier. I don't know. So a lot of them, people may think that he knows, so he's promoting. It's not like that. I was teaching DT. I got very good feedback for DT. But when I realized that I'm not doing 100% justice to DT the way I'm doing it for SFM. I stopped teaching. That is the only genuine reason why I stopped teaching. And now a friend of mine is teaching. So whoever comes to me, I tell them go to him. Because not everybody can tolerate Vinod Gupta sir books. VG is the best on earth. Not in India. On earth, those are the best books. But you can't get grip of it because there are 10, 12 books with so many pages to study. I studied VG sir's book to get the marks I got. When I started teaching DT, to be very honest, I took his books, I summarized it, started teaching. And people loved my teaching. They loved it for DT. But then I realized that I have a friend in Mumbai. He called me up, he said, "Sir, kya kar rahe ho? Kuch to hame bhi karne do." Then one day when I stopped, I told him that, "See, you told me I stopped teaching." So now I recommend his name to everybody. Because I strongly feel CA final, it has to be, the person you go to has to be brilliant in his subject. Brilliant. So when I was teaching DT, I know the concepts because I am into CA for so many years. I know so many people from the industry. But somewhere, no, when you are not able to develop images in your mind, when I say you go to the assessing officer, I'm not able to relate because I never went. So better send the student to somebody who has more practical knowledge. When I started teaching SFM, I saw a lot of people on videos on YouTube, at least the popular ones. Now, though everybody's teaching everything. And I found that big gap that there is no connection with the real life scenario. So, okay, I have to incorporate this in my teaching. Plus, my practice helped me a lot with that. If you go to a good faculty, at least at CA final level, your 50% job is done. I strongly believe that 50%, more than 50% is done because they set a path for you. You just have to walk that path. Abhi you come and challenge me, you do whatever you want to do, I won't study. That's a different thing. But if you're assuming that you're matured, you want to understand things properly, like Punarvas sir. His way of teaching is brilliant. And I'm not saying this because I'm sitting on this premise. People who know me for 6, 8 years, they know I have recommended him like anything. We were not in talking terms for last 4, 5 years. I mean, we didn't have any rivalry. He came, met me in 2019. He said, "You come and teach in my institute." I said, "I am already teaching in Bangalore Law College here. How does it matter?" And we used to get 250, 260 students. Where will you accommodate in your class? Then for me only, you have to take a bigger class. Makes no sense. Then I met him. Then I realized there is a law faculty. Then I saw his videos. I loved his way of teaching because he picks up the raw bare act. Nobody has guts to do that. Nobody has guts. So I was referring him for all these years. So in my brain, there was a faculty. I go to Kerala. Once they told me some law faculty is needed, immediately took out his number, shared. We were not talking. But students, the objective is this fraternity should benefit. I don't even know the person. On my WhatsApp, you will find hundreds of messages. Check Punarvas sir, check Punarvas sir. Because students come and ask me because they know this person will give a genuine feedback. I'm not praising myself, but I followed this throughout my life. Whether I like you or not, I was teaching in Sampath Academy, but I stopped going there. But that does not mean Sampath sir does not know how to teach costing. So if somebody comes to me and tells costing kahan karna hai, then you can go to Sampath sir. So just now, our classes happened. Means it was all of a sudden decision. And I take all my decisions in life like that, very impulsive. Otherwise, you will never see, within 5 days again, I'm going to Kerala. This cannot be planned. I'm a family person. I'll come for classes, I need at least 15, 20 days with my family. Then only I'll go for my next batch. Because I have seen that kind of life also where I'm teaching 10 months a year, 10 months. Continuously I'm teaching. Abhito, I'm still carrying my notes. You won't believe me if I say this to you. But you talk to students of 2019-20, 3,24,786 is the answer. I'll speak from my mouth and they will, "How do you know this? Arey, I'm teaching the same thing for so many years here." But now I space out, okay, I take some time, I say, take some breath, and because video classes have also helped. So you won't believe me if I tell you this. I'm sitting in my office doing some trading and all. What clicked? Okay, we should do in Bangalore one batch. Picked up the phone, dialed him. "Can I take classes at your institute?" That's "Sir, you are serious?" I said, "Yeah, I want to come." "When will you come?" Randomly told, "Okay, 15 to 26 can we plan?" He said, "Okay, sir, we'll do." That's how we planned it. So if you, at any classes you take, or you now, if you have already taken, at least for your juniors, you only remember one thing, that you send them to the person who decodes the subject like anything. It will make your life super easy after that, for every subject. And there are no shortcuts. Be committed for classes. You have to go. It's okay if you don't want to go to somebody who teaches for 300, 400, 500 hours, but take classes for sure from a good faculty. That should be the idea. If I go to study law, I want to know what exactly happens in law. And you can only know when somebody teaches you from the bare act. It's very unfortunate that they removed law paper from CA final. Makes no sense. It makes no sense. But you know what they've done? Yesterday I was talking to sir. They have put it in the integrated paper. They put everything in that paper. Everything. I don't want to scare you right now. But they made it very, very ajeeb sa paper. God knows what they wanted to do. Somebody might be fond of khichdi a lot. But they've made a vegetable khichdi basically. If somebody is not having group 2 of the new curriculum, you are blessed, super blessed. And somebody thought, I don't have to study costing now. I am lucky. I think you need to reconsider your luck. Okay, guys, listen now. We are doing something very, very important now. Okay, this I told you guys. There is a variation margin of 5485. Okay. What is transaction exposure? Forex. Foreign currency payable or receivable? Known. Home currency equivalent? Unknown. Because the settlement happens on a future date. This is currency fluctuation risk. I know how much of foreign currency I am supposed to pay or receive, but I don't know what will be rupee equivalent of that. Correct? That is for transaction exposure. Let's take a situation. Indian entity has $5 lakh payable in 6 months. You know how to define his risk. First thing that you do is to define the risk. What is risk for him? Dollar payable, no? So we are worried about dollar appreciating. At the same time, we are worried about rupee depreciating. Now what they do, guys, when they give you the futures, forward contracts you have learned, no? Now we're talking about futures. Either they will give you in exam dollar futures or rupee futures. Hedging through futures is very easy. Very easy. You just ask yourself 2 questions all the time. You don't have to learn anything. You will become master in it. Number 1, what are we worried about? We are worried about dollar going up. Correct? Do something that if dollar goes up, you still make money. You create a situation that whatever you are worried about, that is whatever is adverse for you, whatever is your risk exposure, you start enjoying that. So what are you worried about? Sir, I am afraid of dollar going up. So you do something with futures that if dollar goes up, you still make money. So you go long on dollar futures. If you go long on dollar futures, then if dollar goes up, currency market, derivatives market. Right now, rupee per dollar is 80. When you went to settle what? This transaction. When you went to settle this transaction, rupee per dollar became 85. Currency market, you will cry. You're sad because you are thinking, oh, 6 months back we didn't settle. No, now we have to pay 85 for every dollar. Derivative market, you smile. Why, sir? Because you took F plus at 80. You will do F minus at 85. How much you made? 5. How much you suffered here? 5. So whatever extra you suffered here, you make over here. Hedging through currency futures. Hedging through currency futures. What am I worried about? Dollar going up. or I am worried about rupee going down. So do one thing, that if rupee goes down, you still make money. You should go short. You should go short on rupee futures. If rupee goes down against dollar, then also I will make money because I took a short position on rupee futures. See one more example. US entity has pound receivable. US entity has pound receivable. First explain the risk. Pound depreciation, receivable. What are you worried about? Pound depreciation, dollar appreciation. In the sum, one of these two will be given. They won't ask you both. There is no sense in asking both. Either pound futures or dollar futures. What are you worried about? Pound going down. Do something that if pound goes down, you still make money. Go short. What are you worried about? Dollar going up. Do something that if dollar goes up, you still make money. Go long. In other market, if they want to trade in dollar futures, they have to do it in UK. Examiner will not go by logics. Examiner will not go by logics. I'll prove it to you in the very first sum that we do after discussing this, which has come the maximum in exam. We will discuss this. You be clear with your concepts. If they give me dollar futures, I have pound receivable. I am worried about dollar going up. If dollar futures are given, I will take a long position. Simple. Forward contracts, you go to the bank. Forward contracts, you go to the bank. You tell bank, I'll come after 6 months, take delivery of the currency. Or give delivery of the currency, yes or no? But in futures, delivery is not possible. That is why you still have to go to the currency market. Hello? You still have to go to the currency market because delivery will happen in this market only. So why are we using futures in derivatives market? Only for profit or loss. You have pound receivable in this case. You have pound receivable, correct? So if pound receivable, you went short on pound. Let's say during this period, pound appreciated. Pound appreciated. Currency market, happy because we will get more. But that is the very nature of futures, no? I mean hedging. When you are hedging through currency futures, it will protect you against your downside. But it will not even allow you to enjoy the upside. So I'll ask you, why are you so happy, sir? Because pound appreciated. No, I got more. But you took a short position on pound futures, no? So whatever benefit you got over here, you will lose in this market. Because you took a, what did you do? You took a short position on pound futures. So currency futures will protect you against adverse, but at the same time will not allow you to enjoy the favorable. One more example, let's take. Indian entity has pound 1 lakh receivable. First explain the risk. Pound depreciation is my worry. Rupee appreciation is my worry. Pound if goes down is bad for me. So I'll go short. Rupee if goes up is my worry. So let's go long on rupee. Now you got your money, pound 1 lakh. When you entered into all these trades, the rate was 95. Now the rate is 100. Now the rate is 100. Good for us. What will you do? 1 lakh into 100. The entire 1 lakh you settle at 100. Are you happy? Yes. Because you are able to settle at a rate 5 rupees per pound higher than the rate at which you took the transaction. Derivative market, you took a short position at 95, F minus 100, F plus, loss 5. Technically, the moment you take currency futures, you are locking in a price of 95. You are locking in the price of 95 because you got 100, you lost 5, 95 becomes an effective inflow. If this is 110, Then this is also 110. Then your loss is how much? 15. Net how much you got? 95. So it protects you against the adverse, but it does not allow you to enjoy the favorable. So on maturity date, guys, ultimate settlement will happen in the currency market only, because futures delivery is not possible. Sure? Because of this, futures will only result in profit or loss. For taking futures, I have to pay initial margin. For taking futures, I have to pay initial margin. If they give you the rate of initial margin, you should calculate opportunity cost of that, because initial margin is to be paid upfront. So you need to calculate opportunity cost of that. So initially what you will do, decide whether to go long or short on futures. Step 3, what you will do, you will find out the settlement amount, currency market, profit or loss on derivatives, future market, opportunity cost of initial margin. 3 things you calculate on maturity. Between these two comes how many lots I should take. That comes in between. Number of lots. Very easy to calculate. It is exposure divided by lot size. That's the number of lots. Will futures give you a perfect hedge? No. Why? Because lot size is defined. Will forward contracts give you a perfect hedge? Yes. Why? Because contracts are customized. Another thing that can happen, exposure may be given in dollars, but lot size may be given in pound. Means you have exposure of dollar, but futures are available of pound. Lot size defines what futures are available. Then division is not possible. Then what we do, we convert this dollar exposure into pound equivalent exposure. At which rate, sir? At future price. Whatever future you are supposed to take, at that price you will convert your dollar exposure into pound exposure. Then you divide by pound lot size. Then division is possible. So how many steps are there in total? 3. Step 1, whether to go long or short on futures. 2 questions you will ask yourself. What is my risk? How a position in future can help me enjoy my risk? Step 2, number of contracts. Exposure by lot size, same currency. Exposure equivalent of other currency divided by lot size, if both are given in 2 different currencies. Step 3, on settlement what will happen? 3 things will happen, sir. If there is initial margin paid, calculate opportunity cost of that. Number 2, settle the payable or receivable in the spot market. Number 3, profit or loss on derivatives, that is futures. That's it, done. Sir, how this question will come in exam? They give you a scenario, then they tell you, advise which is better, future cover, that is currency futures, forward cover, money market cover, or no cover. These are the things which you have studied so far. No cover means they bindas, on maturity we will see. Forward cover, go to the bank, book a rate, settle at that rate, the easiest. Money market cover, payable, invest, buy, borrow. Receivable, borrow, sell, invest. And finally, currency futures. Okay. Come to page 109. Ultimately, we take the net figure of all 3. All 3. What you are paying as initial margin, that never comes back to you, no? Only futures. Forward also happens, no? Processing fee, upfront processing fee we calculated. Hedging transaction exposure using currency futures. As we know, transaction exposure refers to a situation when a company has a known amount of foreign currency payable, the home currency equivalent of which is not known. One way to hedge against the same is by using currency futures. The first question is decide whether to buy or sell futures. This is step one. Suppose a US company has pound payable, it is therefore afraid of pound rising. If pound futures are given, we have to buy pound futures. We have to buy pound for making payment. We are afraid of pound rising. Hence, to hedge, we will buy pound futures. If you have pound payable, you are worried about pound going up, so you go long on pound futures. If dollar futures are given, firm is afraid of pound rising, that is dollar falling. Therefore, it should sell dollar futures so that if dollar depreciates, company will make profit on dollar futures. Just ask yourself two questions. Don't try to learn anything. What is my risk? That is, what am I afraid of? How position in futures can be taken to benefit from risk exposure? Next is compute the number of contracts to hedge. The currency in which we have a payable or receivable is known as exposure currency, which is found in the above case. Case 1, number of contracts is exposure by lot size. And second case, what we have done is dollar equivalent exposure based on future price divided by lot size we have done. So case 1, you can write over here, same currency, exposure and lot size. The first case is same currency, exposure and lot size, then you simply divide. And case 2 is exposure and lot size are two different currencies. Exposure and lot size are two different currencies. So number of contracts in that case will be dollar equivalent exposure based on future price divided by lot size. We have some space. We'll try to understand one example of each. Okay. You see, the first case exposure is $5 lakh, lot size is $47,500, and future price is dollar per pound 1.2125. That is case 1. Okay. This is example on case 1. This is example on case 2. The first case, guys, if you see exposure and lot size are in same currency, then what are my number of contracts? 5 lakhs divided by 47,500. 10.52. So approximately we can take 10 or 11. Both are correct. Okay, guys. Under hedging, I personally recommend, because every time you take a future, there is money involved in it. So there is extra cost for you. So I personally suggest go for under hedging. Even if you do over hedging, there is nothing wrong about it. Okay. So approximately we will take 10 lots. Second case, guys, we will find out dollar equivalent exposure. We are converting from pound into dollars. Multiply 5 lakhs into 1.2125. How much is that? 6. 606250. Then now number of lots is 606250. Divide by $47,500. How many are we getting? Okay, approximately 12. See, you're not able to create that perfect hedge. That is what we have written below that. Because of standard lot sizes, futures may not provide perfect hedge. Generally, we ignore the unhedged portion. Ignore means you always go for under hedging. However, in some cases, we are required to take a forward cover for the unhedged portion. Sometimes questions will make it even more difficult for you. They will say whatever portion is unhedged, for that you take a forward cover. Which means in this case, guys, you took 12 lots, no? Each lot is worth how much? 47,500. Do it on your calc. 12 into 47,500. 5 lakh? Okay, whatever you got. Minus 606250. 36,250 you got. On that 36,250, you should book a forward cover. The company's risk averse, highly risk averse. Then they ask you to do it. Now, sir, what should we do in exam? If the question is silent, don't do anything. Just under hedge and leave it. But if they specify that you should take a forward cover, only then we will take a forward cover. Understood? So I've said refer class discussions for further understanding. We'll do one sum on that later on. This is the reason why forward contract is a better choice, as you can take a contract for any amount and any duration, all thanks to its non-standardized nature. That is, it is customized contracts. If I ask you which one is financially better, you will say, sir, we don't know. We have to solve and see. But which one is more convenient from client's perspective? Maybe forward contracts are better. You understood what I'm saying? So financially, it's not better. If it was better always, we don't need to teach you currency futures. Financially, currency futures can be useful. But because currency futures is done through exchange, compliances are too many. Understood? Next page, if you see, we have again written a note, very, very important for your understanding purpose. It is important to note that futures can only be used to hedge, but no delivery is possible. Futures can never give you delivery. Learn this by heart. Futures can never give you delivery. Hence, actual settlement is done in cash market. This is not the case with forward contracts, as customers in case of forward contract can directly settle with the bank. Okay. We'll look at question number 16 now. Because market is very important. XYZ Limited is an export-oriented business house based in Mumbai. The company invoices in US currency. Its receipt of $1 lakh is due on September 1, 2005. Market information as at June 1, 2005 is exchange rate dollar per rupee is given as 0.2140, which is dollar per rupee is given to you, which is fine with us. Base currency is in the denominator. From June, we need a settlement on September 1. How many months are there? July, August, September. 3 months are there, right? 3 months are there. Then why have they given us 1 month forward contract of no use? We need 3 months forward, right? Similarly, they have given you June futures data and September futures data. I have a settlement in September, so for me, September contract is relevant. I will take September maturity. So September is 0.02118. Lot size is given in rupee terms, which means this specifies rupee futures are available. Hello? Rupee futures are available. Your exposure is given in dollars. Lot size is given in rupee. So you have to convert it into rupee equivalent exposure, then divide by lot size to find out the number of lots. Correct? On September 1, 2005, the spot rate for dollar per rupee becomes 0.02133. And the currency future rate is 0.02134. This will be used for settlement purpose. Comment which of the following methods would be most advantageous for the company. Number 1, using forward contract. Number 2, using currency futures. And number 3, not hedging the currency risk. Okay. Let's write. Indian entity has $1 lakh receivable. Indian entity has $1 lakh receivable in 3 months' time. Indian entity has $1 lakh receivable in 3 months' time. It is therefore exposed to currency fluctuation risk. It is therefore exposed to currency fluctuation risk and is evaluating the following alternatives. And is therefore evaluating the following alternatives. Next line, alternative 1. Alternative 1, forward cover. Alternative 1, forward cover. It can enter into a contract. It can enter into a contract to sell dollar to sell dollar 3 months forward at the rate of $0.0217, to sell dollar 3 months forward at the rate of $0.0227. Therefore, rupee inflow after 3 months. Rupee inflow after 3 months. 1 lakh divided by 0.02127. 4701, 458. This inflow is certain or uncertain? This is certain. Alternative 2. Alternative 2, currency futures. Alternative 2, currency futures. Step 1. So what is the first thing we do? We decide what to do with the futures. Please write. Indian entity has dollar receivable. It is therefore worried about dollar depreciating. It is therefore worried about dollar depreciating, that is rupee appreciating. Full stop. Since rupee futures are available, since rupee futures are available, we will go long on 3 months rupee futures. We will go long on 3 months rupee futures. Bracket September contract. At the rate of 0.02118. at the rate of 0.02118. Correct? So you are worried about rupee going up, so you go long on rupee futures. If rupee goes up, then also you make money. Okay. Step 2. Exposure is equal to $1 lakh. And lot size is equal to rupees 4,72,000. Then what is my rupee equivalent exposure? 1 lakh divided by 0.02118, which is 4,721,435. Therefore, number of contracts is equal to rupees 47,21,435 divided by rupees 4,72,000, which is 10 F plus. What was the exact value you were getting? 10 point? Okay, this is almost same. So 10.03, approximately we have taken 10 F plus. Step 3. On maturity. Step 3 on maturity. See, you have taken futures at 0.02118. Now the price of future has become 0.02134. You have taken a long position at 0.02118. This is the future price, see, which is 0.02134. So there is a profit on squaring of futures. Please write profit on squaring of futures. .02134 minus 0.02118 into number of contracts taken 10 into lot size rupees 4,72,000. 0.02134 minus 0.02118 into number of lots 10 into lot size 4,72,000. How much? 755.2. That is dollars. In this some price currency is dollars, guys. The profit is in dollars. No mistakes, okay? No rupees, please. It is dollar per rupee. The profit has to be in dollars. Next, total dollar receivable. What is total dollar receivable? $1 lakh, which is your invoice amount plus 755.2. Which is 1,00755.2. This will be sold in the spot market at the rate of, what is spot market rate given? 0.02, 0.02133. Therefore, rupee inflow is equal to 1,00755.2 into 0.02133. Sorry. Divide by 0.02133. See how much we are getting? 47 lakhs, 23,638. Okay. Next what? Interest on margin blocked. For September contract, what is the margin? Interest on margin blocks. June contract we won't see. We will see September contract. What is the margin needed for September contract? 15,000 and interest rate applicable is 8%. 15,000 I paid into number of lots is 10 into 8%. Validity of the contract is 3 months into 3 by 12. $3,000. Interest on margin blocked is 3,000. Therefore, net inflow is equal to 47,23,638 minus 3,000. Rupees 47,20,638. Is this certain or uncertain? This is uncertain. Because you are using the spot rate on maturity. How do you know the spot rate on maturity on day one when you are trying to take the futures? Technically speaking, guys, both these rates, they should have given a probability distribution. I don't think there is anything difficult here to understand. We are not standing on the September maturity. If you are standing on September maturity, then there is no forward analysis. Here they are asking which strategy you think is better for the company. The strategy which is better, these rates we assume they have given you summation PX. This is an estimation. We don't know what rate we will settle the spot market transaction and the future also. We don't know any of it. We have done estimations. So for currency futures, the inflow is uncertain. But if it is uncertain, does it make any bad choice? No, because you have hedged. No. It goes in any direction. One will be favorable, one will be unfavorable. Understood? So this is uncertain. Next. Alternative 3. No cover. Company will sell $1 lakh in the spot market on maturity. Company will sell $1 lakh in the spot market on maturity at the rate of 0.02133. If rupee inflow is equal to 1 lakh, divide by 0.02133. 46, 88, 233. Certain, uncertain? Obviously, uncertain. So you have 4720, you have 47.1, and you have 46.88. Where do you get the maximum? Inflow higher the better. Please write. Since rupee inflow on maturity is highest under alternative 2, Since rupee inflow on maturity is highest under alternative 2, we recommend hedging through currency futures. We recommend hedging through currency futures. Take 2 minutes time, go through the sum. If you have anything to ask, you can ask me. Then I'll ask you a question.
Like then by the month, my initial. Is that work? It is.
Guys, you understood? Huh? It is uncertain, which I have told you for your understanding purpose. But uncertainty is not there. You are not exposed to risk anymore. Please try to understand. We are not using here uncertain in a negative frame of mind. I'm only trying to make you understand that the rates on the date of maturity are uncertain, making your final answer uncertain. The strategy is not bad. Because if the rates fluctuate, one will help you, one will make you suffer. That's it. Anything else, guys? What makes this sum impractical in real world? Rupee futures are given. It is very, what do I say, wrong framing of a question. Because if rupee futures you're giving, it means you are saying Indian entity, in order to hedge its transaction, has gone to US market, and in US market they have taken a rupee contract. Think about it. If you think you can justify this, you tell me that, sir, you are wrong. This is the approach. To me, this looks very, unrealistic. Indian entity, if they want to hedge using currency futures, they do it. They will go for dollar futures. If you give me rupee futures, then it means we are doing everything in the US market, which brings in even more legal compliances and everything, because we are doing FNO in some other country. Not even sure if we are allowed to do it. Think about it. So structure-wise question is not looking good. But this is the most asked question from this segment. Okay. Now I know you people are super champs and you will give me answer in 5 minutes. Question number 21. Okay, don't take pressure. 10 minutes given. Everybody got the answer? Okay, take a break.